Welcome back to Investing Talk Podcast.
Today we're looking at Coinbase.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want to look into, leave it in the comments below.
So let's get into the analysis. We saw some extremely robust results from them in Q3 2025.
Robust feels like an understatement.
It really does. It shows strong resilience and growth, especially as the crypto market volumes started to rebound.
Okay, so let's hit the headline numbers, because they are pretty eye-popping. Total revenue was $1.87 billion.
Yep, a massive 55% jump year over year.
And even quarter over quarter, it was, what, 25%?
25%. But here's the thing. Revenue growth is great, but is it just them riding the bull market wave?
That's the key question, right? How much of this is structural?
Exactly. And you see the answer in the margins. Net income was $433 million. That puts their GAAP margins north of 40%.
30%, wow.
And the adjusted EBITDA, which I think is a better measure of core profitability, hit $801 million.
So that's a 45% margin. That's huge for a tech company in this space.
It is, because it shows real, disciplined cost control. It proves they can scale efficiently now, not just spend recklessly when times are good.
And that efficiency, for you listening, that's what leads to the big earnings beat. EPS came in at $1.44. The projection was only $1.09.
A 32% beat. It's significant.
So where did the revenue actually come from?
Well, the transaction revenue really roared back to life. It hit $1 billion, up 37% from the last quarter.
And what's the split there between retail and the big guys?
Retail was very strong, about $59 billion in volume, which brought in around $844 million in revenue. But the real story, the acceleration, it's the institutions.
Okay.
Institutional trading volume surged 122% quarter over quarter.
122%. That is an explosive number. What's pulling them in so fast?
It's really two things, regulation and now derivatives.
Ah, the Dividend acquisition. How much of an impact is that having already?
It was immediate. It contributed $52 million to that institutional segment right out of the gate.
So it's already paying off.
It is. It shows they're serious about becoming a full financial platform, not just a place to buy and sell.
Okay, so let's unpack that, because this feels like the real story. The transaction revenue is great, but this structural shift is where it gets really interesting.
Absolutely. The pivot to being an infrastructure player is happening right now. Their subscription and services segment hit a record.
How much?
$747 million, up 14% sequentially.
And what's the forecast for that segment for the full year?
They're projecting it'll reach $2.9 billion for the full year 2025.
Okay, let's pause on that. That subscription and services segment now makes up 41% of their total revenue.
41%.
If you go back to, say, 2020, that number was only around 4%. Why is that shift from 4 to 41 so important for someone thinking about this long term?
It completely changes how you value the company. A business that lives and dies on transaction fees is volatile. It gets priced like a casino, but a company with almost half its revenue coming from predictable subscriptions, from custody, from interest, that gets priced more like a software company. It's just a much more durable business.
And a huge piece of that durable income is from stablecoins, I assume.
Precisely. Stablecoin revenue alone was $355 million in Q3.
Just from stablecoins?
Yeah, that's mostly interest income from the reserves backing USDC. And that's supported by, at its peak, $15 billion in USDC balances on their platform.
So the whole financial foundation just looks incredibly solid.
It is. The balance sheet has $74 billion in assets. And, even simple net interest revenue from their cash positions was up 66% year over year.
So what does this all add up to for their competitive moat?
It's multifaceted. First, you have the network effect. They are the leading regulated U.S. exchange. Big money goes there first.
And it's hard to leave once you're in.
Right.
The switching costs.
Exactly. When you have your assets in their custody, you're staking through them.
Yeah.
It's sticky. And the Deribit acquisition deepens that moat. They're aiming to be the everything exchange.
They mentioned a derivatives volume number from Deribit that was just staggering.
$840 billion in notional volume.
Can you break down what notional volume means for our listeners?
Sure. It's the total value of all the assets underlying the contracts they're handling. So while the fees are a small piece of that, it means they are the plumbing for almost $1 trillion of institutional activity. It's a measure of trust and market share.
And you really see that moat when you compare them to, say, a competitor like Robinhood.
You do. Robinhood's growth was almost all transaction-based. They just don't have that 40+% recurring revenue base to fall back on when trading slows down. So if we move from the fundamentals to what the market is thinking, The technical picture is pretty bullish.
It is. The stock's up almost 50% year-to-date in 2025. Started the year around 248 bucks, and it's in a golden cross.
Can you explain what a golden cross signals to investors?
Yeah, it's a classic long-term bullish sign. It just means the 50-day moving average, which is the shorter-term trend, has crossed above the 200-day average, the long-term trend. It basically signals that smart money has been accumulating the stock for months.
And we're seeing its price support hold up really well, right? It seems to be tracking Bitcoin.
Directly. When Bitcoin finds a floor around that $70,000 level, the stock seems to find its floor right around $200 to $220. It gives investors confidence.
And institutional money seems to agree. We're seeing it in the 13F trends.
What exactly are 13Fs for people who don't follow those?
They're just quarterly filings where big institutions have to disclose what they own. And what the data shows is what we call cluster buying, especially after that Deribit deal. Big funds are buying into the infrastructure story.
And the macro tailwinds for the whole sector are pretty strong.
Very strong. You've got firms like Citi calling for Bitcoin to potentially hit 143,000. That obviously helps Coinbase. And you have JP Morgan projecting the entire stablecoin market could swell to $500 billion or more by 2028. Coinbase is the plumbing for that.
We're seeing real-world adoption, too. It's not just speculation anymore. I saw Klarna's partnering with them for USDC.
Klarna, MoneyGram. These are established financial players using their rails. That's huge validation.
So looking ahead, what are the big catalysts on the calendar?
Well, first up is Q4 earnings. That's scheduled for February 12th, 2026.
And the consensus is what, about $1.06 for EPS?
Yeah, but a lot of analysts are quietly expecting a beat, mainly because of that high margin growth in derivatives and stablecoins.
And on the macro side, you've got continued ETF inflows, hope for rate cuts, and potential regulatory clarity.
That last one is maybe the biggest wild card. Specifically, there's this thing called the Genius Act for stablecoins.
How would that impact them?
It would be a massive catalyst. Right now, stablecoins are in a regulatory gray area. If a law like that passes, it creates a clear federal rule book. It completely de-risks their huge stablecoin business and could drive a ton of investment toward regulated players like them.
Okay, so the outlook seems strong. The story is compelling. But we have to talk about the risks. This is still crypto.
Correct. You can't ignore the downside. The number one risk is still just core crypto price volatility.
Right. For all this talk about diversification, transaction revenue is still 59% of their business.
It is. So if a big recession hits and Bitcoin falls hard, say to a bear case of 78.5K, their revenue is going to take a direct hit. No way around it.
And there are longer-term competitive risks too, aren't there?
Yes, specifically around that all-important recurring revenue.
You're talking about CBDCs, central bank digital currencies.
Exactly. That's a major long-term threat. If the U.S. government issues its own official digital dollar, what happens to the market for private stablecoins like USDC?
It could really shrink their addressable market. The government could just cut out the middleman.
It's a serious headwind to watch. It could cap the growth of what is now a core part of their moat.
So, wrapping this all up.
Yeah.
What's the bottom line here? The good news is management has proven they're resilient.
They have. That Q3 beat, the cost discipline, the fact that 41% of their revenue is now recurring, it all shows that the business can weather a downturn much better than it could in the past.
They seem structured for compounding growth now, not just boom and bust cycles. And that average revenue per user, that ARPU, is projected at $62 a month. They're getting much better at monetizing their user base.
So if you connect this to the bigger picture, the thesis is that Coinbase is becoming the dominant, regulated U.S. crypto infrastructure play. It's the whole package.
The premier everything exchange going forward.
Exactly. They capitalize on the trading frenzy, but they're also building this stable, long-term plumbing. The real question for the future is whether its valuation starts to be based on that recurring revenue moat and not just on the price of Bitcoin.
That's a powerful thought to leave you with. Remember to subscribe to Investing Talk podcast so you don't miss our next analysis.